Welcome back to the deep dive. Today, we're attempting an exercise in what you might call financial alchemy. We're going to be diving straight into the mechanics of a conceptual revolution. To really get this, we're asking you to momentarily set aside some of your traditional assumptions, about national wealth, global power, all of it. Let's just start with a single really intriguing question. What if the long-term stability and strength of a sovereign currency, the very foundation of a nation's ability to trade and to govern, what if that could be enhanced?
Enhanced how?
Not just by the usual things, not by political stability or economic output or even military might, but through a calculated complementary synthesis with a non-sovereign digital asset.
That changes the entire definition of an asset, doesn't it?
It really does.
For decades, the global financial system has operated almost entirely on the foundation of sovereign authority.
Right.
It's this massive $200 trillion edifice, and it's all anchored by sovereign debt.
Right. Specifically things like short-term treasury bills.
Exactly. Which are, at the end of the day, a nation's promise to pay. And, we have to be fair. Domestically, within a country's borders, this system works extraordinarily well.
Absolutely, it does. It provides incredible stability and velocity inside its own borders. But, and this is the critical weakness we have to address today, there's friction.
So much friction.
That sovereign promise, that T-bill, it just starts to degrade the moment that value tries to cross a state line. Suddenly you're in this complex web of correspondent banks, arcane regulatory rule.
And the fees.
Yeah.
Prohibitively high fees and these incredibly slow settlement times.
We're talking about real measurable inefficiency here. I was looking at the latest figures, and the average cost of a global cross-border payment still hovers above 6%.
6%. That's just staggering when you think about it. It's essentially a global money tariff.
A global money tariff. I like that. It's a hidden cost of this 20th century banking architecture that most people don't even realize they're paying.
Well, and this massive friction, it just reduces global money velocity. It acts like a persistent hidden tax on economic throughput all over the world.
And that inefficiency, that marginal degradation, that's the precise opening for genuine financial innovation. So today we're looking at a proposed solution that doesn't seek to, demolish the traditional sovereign credit system.
No.
It's trying to radically upgrade it. Marginally, yes, in terms of adoption at first, but profoundly in terms of its potential effect.
And this whole upgrade, it really hinges on integrating the absolute scarcity and the hardness of Bitcoin, what some people call its digital mass, with the stability and immediate liquidity of traditional credit instruments, like the T-bill.
Right.
The ambition is to build a global, friction-free financial layer that operates, it's independent of existing geopolitical boundaries, but it's still coupled with them.
And if that integration is successful, if this new financial architecture can really provide reliable, high-speed value transfer that respects the global nature of commerce rather than the localized nature of sovereignty, then this profound possibility emerges.
Which is?
It might eventually mitigate the whole issue of currency wars, that continuous, often destructive cycle of competitive devaluations nations engage in to boost their exports or gain a trade advantage.
So the foundation of a nation's credit is this hard, globally recognized digital matter. The incentive structure for devaluing your local fiat it fundamentally changes.
Exactly. That potential for a systemic upgrade, the creation of a superior form of global currency, that is the core mission of today's deep dive.
And I think it's fair to say we were inspired to dig into this specific architecture after hearing Michael Saylor's keynote address.
Yeah, that was at the recent Bitcoin MENA conference. He outlined his vision for a multi-trillion-dollar opportunity, which he named digital money. But it's not just a commercial product, is it? It's more of a philosophical and engineering framework.
It is. It's a framework for how value should be conserved and transferred in the digital age. And Saylor approaches finance from this pure engineering-first perspective. It's really rooted in physics and thermodynamics.
He's basically asking, if the global financial world is suffering from this measurable inefficiency, this friction at the borders, what is the core mass energy problem that needs solving?
Right. You need an architecture that balances the two fundamental needs of a complete economic system.
Okay, let's unpack this with the physics analogy because I find it so helpful. He describes the solution as a financial transformer, or maybe more accurately, a bridge.
A bridge, yes.
And its function is to take the raw, volatile, immense potential power of Bitcoin, which he calls economic mass, and convert it into the stable, spendable energy of fiat currency. He likens that to radiation or light.
It's a great analogy. You can't plug a raw, high-voltage power source directly into your house, right?
Yeah.
You need a transformer to step down the voltage.
Exactly. You'd blow out every appliance you own.
Precisely. The challenge is converting that chaotic high-energy input into a stable, predictable output. And the specific instrument that's been engineered to perform this conversion is what we're analyzing today, STRC.
Which stands for, and it's a mouthful, Variable Rate Series, a perpetual stretch preferred stock.
It is a mouthful of finance jargon, but its conceptual role is actually quite simple. It is the frequency converter.
A frequency converter, I love that metaphor. It strips the inherent volatility, the high energy, unpredictable price swings from the underlying Bitcoin collateral.
While, and this is the key, rigorously maintaining its dollar-denominated par value and offering a stable, predictable yield. It's this fascinating interplay of physics and finance where volatility isn't destroyed, but it's managed, contained, and monetized.
And this management strategy is so crucial because the goal here is an upgrade strategy. It's rooted in what they call assimilation over resistance.
Right. This whole project is not about being a crypto-anarchist trying to dismantle central banking institutions. It's about creating a superior instrument.
An instrument that transforms a highly volatile, non-yielding asset Bitcoin into a stable, yield-bearing credit instrument that, it speaks the native, cautious language of institutional treasuries and sovereign reserve managers.
And Strategy Inc. has pioneered this really meticulous, multi-phase method to financialize Bitcoin. They transform that volatile commodity into what is functionally a highly sophisticated digital T-bill.
Specifically designed to bridge that massive gap between localized sovereign liquidity and the urgent global need for frictionless velocity. This is really an operational blueprint for how central bank reserves could evolve.
It is, and this transformation requires a deep technical understanding of the financial engineering involved, which we are about to get into. But for those of you who are finding this conversation fascinating and maybe a little overwhelming with all the specialized terms, we do want to remind you that we've compiled a comprehensive resource.
That's right. On that note, we now have a full curated course on STRC available on YouTube. It's a playlist of selected segments from our deep dives. It really provides the foundational knowledge you need to grasp the engineering complexity we are about to explore.
So we really encourage everyone to check out the link in the description.
Yep.
It will definitely accelerate your understanding. I'm Satoshi.
And I'm Satoshi. Now, before we jump into the financial physics, we just want to take a moment to acknowledge you, our audience, and to express some genuine gratitude for the tremendous response and engagement we've been seeing.
It's been incredible, really.
It really is. We started this show with a simple hypothesis. Is there space for really deep, rigorous research and analysis that exists outside the usual academic campus settings or, the think tank chatter, which often feels trapped in the political arguments of the past?
And it's just so clear that you're all as fascinated by these deep dives into first principles as we are.
We're seeing a ton of momentum. And to keep producing this kind of in-depth, high-quality content, and critically, to start creating better visual context for our often complex analyses, we really need your continuing support.
Yeah, we're trying to unlock funding for a Mosaic AI video editor. It's a tool that will allow us to layer complex data and visual models seamlessly into our analysis, which would be a huge help for topics like this one.
It would. And to reach that goal, we need to hit 1,000 subscribers across all our major platforms. So please, if you enjoy these detailed discussions, just take 2 seconds right now to subscribe on YouTube Music, Spotify, Apple Podcasts, or wherever you listen.
Your support directly impacts the depth and quality of future deep dives. And again, if you are following us on YouTube, please do check our curated playlists. They are an excellent resource for accelerated learning.
Okay, let's dive into the fascinating world where these seemingly opposing forces of store of value and medium of exchange converge into a powerful new financial architecture.
Let's do it.
So let's begin with the grand unifying theory of finance, rooted in thermodynamics, that underpins this entire architecture. We're talking about the fundamental duality of finance, mass, radiation, and the challenge of solving their coupling problem.
Right. And a functional global economy, one that can preserve wealth across generations and transmit value instantly across borders, it needs both of these elements. It's like the 2 poles of an electrical circuit.
You need a store of value, which represents economic mass.
And you need a medium of exchange, which represents economic radiation or light.
Okay, so let's define these elements clearly, starting with Bitcoin as digital mass, what they call the fermion.
Bitcoin is digital matter. It's concentrated, localized economic energy. And its very existence is defined by absolute, verifiable scarcity and immutability.
So, like physical mass, it can't be counterfeited.
It cannot be counterfeited. And its creation requires measurable, real, energy proof of work. Saylor calls it a thermodynamic truth because its cost of production ensures its honesty. It is the ultimate battery for storing value over a really long time scale, say 100 years.
What's so fascinating about that is that its strength is also its functional weakness. Just like physical mass, it's too heavy or too dense for frictionless daily use.
It's too volatile.
Way too volatile. If you tried to use raw Bitcoin for day-to-day commerce, the energy is just too chaotic. The friction inherent in its price movement is too high for a stable payment system.
It's an unmoving anchor, but it doesn't travel well. So now let's contrast that with fiat currency, the dollar, the euro, the rupee. These are digital light, the boson.
Digital light or radiation. These currencies have immense velocity. I mean, they move at the speed of communication and they're absorbed easily by the economy for instant, stable transactions. They are the perfect medium of exchange.
But their defining weakness is structural. They have no intrinsic mass.
They lack scarcity.
Exactly. They can, theoretically, be created infinitely by sovereign authorities.
Yeah.
And because of this lack of mass, they suffer from the financial equivalent of redshift. They lose energy over distance and time.
We all know this phenomenon. It's called inflation, the constant loss of purchasing power.
And crucially, the reach, or the effective coupling of these fiat currencies, is based on the manual force of the sovereign state. Its military protection trade routes, its tax authority, the durability of its institutions.
So that signal degrades quickly at the edges. When the currency travels beyond the effective range of that sovereign power, its velocity slows and its costs rise, which brings us right back to that 6% global money tariff we mentioned.
Right. And this whole context brings us to the traditional anchor and its limits. The trillion-dollar system we all rely on is anchored by the sovereign nation state. The national tax base, the military might, the entire economic output, these are the ultimate abstract assets backing the fiat money.
And the essential mechanism that converts that abstract sovereign value into usable currency and credit is the short-duration treasury bill, the T-bill.
The T-bill is the functional bridge. It's what turns the nation's promise into spendable, liquid credit, and it's what ensures domestic stability.
We've even seen this foundational structure get formalized and modernized in the regulatory space. I mean, for listeners who might not recall, the Genius Act of 2025 was a huge deal.
It really was. It formalized the regulatory preference for stablecoins that were backed by ultra-short-term, highly liquid 93-day T-bills.
And that regulation is so crucial because it defined the gold standard, or maybe the T-bill standard, for the kind of instantaneous stability and liquidity that digital credit instruments have to achieve to be considered institutional grade.
That is the benchmark. So the T-bill creates this seamless, stable credit within a sovereign jurisdiction. But that's where we run straight into the efficiency gap.
Right. While it is perfect domestically, the system just hits a brick wall when global interconnectivity is needed.
Just think about the complexity. If you want to move $100 million between two countries, it requires multiple correspondent banks, anti-money laundering compliance across 2 or 3 different jurisdictions, and all the conversion fees.
We already established the 6% cost barrier, but the time element is just as destructive. I mean, settlement times can range from 1 to 5 business days. In an age of instant information, a 5-day settlement for value transfer is it's unacceptable friction.
It's that urgent need for marginal improvement we identified earlier. It's not that the dollar doesn't work, it's that the global distribution architecture built around this sovereign anchor is slow and expensive.
The current system struggles with global velocity because its anchor is sovereign and localized, not global and non-sovereign.
Which brings us to the central dilemma, the missing link. How do you achieve this impossible alchemy of coupling the volatile high-energy mass of Bitcoin with the stable high-velocity radiation of fiat?
How do you take that immense long-term store of value and let it radiate outward in a stable, predictable, high-velocity form?
Because direct coupling fails.
It fails spectacularly. If you try to use raw Bitcoin, you inject a systemic instability that central banks, by their very mandate, cannot tolerate.
So you need an intermediary structure. You need a financial converter that absorbs the chaotic energy on one side and outputs pure, stable, dollar-denominated yield on the other.
And that is the specialized engineering function that STRC was designed to execute.
This is the foundation upon which Strategy Inc. built its entire financial fortress.
Okay, so as you said, STRC wasn't some overnight invention. It was the result of a very deliberate five-phase engineering evolution. And I think understanding this journey is essential.
It is because it demonstrates how a volatile commodity Bitcoin was systematically financialized, how it was turned into an institutional-grade yield-bearing asset.
It shows a real commitment to solving the volatility problem through structural design. So let's start with phase one, the cash conversion. This was the defensive pivot back in 2020.
Right. Strategy Inc. took its excess corporate treasury cash and just converted it to raw Bitcoin. At this point, the logic was purely defensive. They were treating Bitcoin solely as a superior store of value against monetary inflation.
So they were just swapping dollars, which they saw as suffering from that financial redshift, for what they considered digital gold. A simple balance sheet maneuver, nothing too complex yet.
Exactly. But phase two introduced true innovation, the ATM offering, or what they called accretion farming.
ATM stands for at-the-market offerings. So they were continuously selling common stock, their ticker MSTR, directly into the market over time.
And they introduced a critical new metric here, which really defined their operational genius: Bitcoin per share, or BTC yield.
Okay, explain the mechanism here, because it sounds a little counterintuitive selling shares to increase the density of the underlying asset.
Well, it was ingenious. Because the market valued their underlying Bitcoin exposure so highly, their stock, MSTR, often traded at a significant premium, sometimes as much as 15 to 20% above the net asset value of the company's Bitcoin holdings.
I see. So there was a gap between the stock price and the actual value of the Bitcoin it held.
A huge gap. And Strategy Inc. was able to issue new shares at this premium, generating fiat capital out of thin air, essentially, out of that valuation gap. They then used this premium capital to buy more Bitcoin.
So by doing this, they were actually accreting more Bitcoin for every single existing shareholder.
Exactly. They were leveraging the market's high valuation of their Bitcoin holdings to buy more Bitcoin. It's a mechanism for continuous, non-dilutive leveraging and accumulation. The company was literally selling a tiny piece of its common equity to increase the density of its digital mass per share.
Which is brilliant. And that moved them swiftly into phase three, convertible debt. This was the first time they used large-scale leveraging capital through the fixed income markets.
Right. They tapped institutional investors, issuing these convertible notes and borrowing fiat at very low, predictable interest rates, often much lower than the historical appreciation rate of Bitcoin.
And the primary goal there was to accelerate their BTC yield even further.
It was. They strategically leveraged the spread, the significant difference between the low cost of acquiring fiat capital and the rapid appreciation of the digital asset. They borrowed cheap, stable money to purchase the volatile, appreciating asset.
So they were magnifying their position and accelerating the accumulation of digital mass for their treasury.
That's right. But up until this point, the focus was entirely on capital appreciation. The investor was purely speculating on the rising price of Bitcoin. And Strategy Inc. recognized that this model had its limits if they wanted to onboard more conservative capital.
Like institutional treasuries.
Exactly, which led to phase four, preferred equity. This served as the critical yield bridge.
The market need became clear, right? Many large institutional funds, pension funds, potential sovereign treasuries, they are legally mandated to hold only yield-bearing assets. They can't just hold a volatile, non-yielding commodity. They need cash flow.
So, Strategy Inc. introduced fixed-rate preferred stocks, instruments like STRK and STRF. This created the first hybrid instrument, a stock that was engineered to behave like a bond, offering regular, predictable dividends backed by the corporate Bitcoin treasury.
This was really the initial attempt to wrap that volatility in a yield structure that would be suitable for more conservative portfolios.
And it paved the way for the combination of this whole five-phase engineering process. Phase 5, the creation of STRC, the final digital T-bill structure.
STRC, the refined final form. The variable rate series, a perpetual stretch preferred stock. Let's break down that jargon because this is where the engineering really shines.
Okay, so unlike the earlier fixed-rate preferreds, STRC is designed with a variable rate dividend. And this isn't arbitrary. The rate adjusts dynamically and precisely to ensure the securities market price remains fixed near its target par value of $100.
So the variable rate acts like a dynamic brake against price fluctuation, maintaining stability for the person holding it.
Exactly. And the term perpetual is key for institutions. Unlike a standard T-bill, which has a finite maturity date, perpetual means the instrument has no maturity date. It provides a permanent, yield-bearing exposure to the underlying asset base, which is ideal for long-term reserves.
And finally, the term stretch.
Stretch implies its position in the capital stack. It is subordinate or junior to senior debt, but it is senior to common equity. This is essential for the risk management layer we're about to discuss.
Okay, so the structure is specifically designed to perfectly mirror the key features of a monthly treasury bill. It is liquid, it trades near par at $100, and it yields interest monthly. But its backing is fundamentally different.
It's not backed by a single sovereign tax base. It's backed by the universal, mathematically conserved digital mass of Bitcoin. This entire evolutionary path transforms Bitcoin from a speculative commodity into a stable, yield-bearing credit instrument that's suitable for the most conservative balance sheets in the world.
We absolutely have to focus now on the function of STRC as the financial transformer and how its internal mechanism solves the two greatest weaknesses of traditional sovereign reserves.
We called it the bridge or the frequency converter. So let's reiterate its engineering goal: to absorb chaotic, high-energy price fluctuations, volatility that can exceed 70%, and output a stable, predictable yield in U.S. dollars.
And the targeted yield is significant, around 10%.
Right. And this transformation function directly addresses what we call the gold problem, which is the historical objection sovereigns have had to holding any commodity.
Central bankers love to hoard gold because of its stability. They prefer non-volatile assets above all else, even if the returns are low.
Yeah.
But as a modern financial asset in a high-speed, digital, global economy, physical gold has two catastrophic failures.
Failure number one, zero yield.
It just sits in a vault.
It sits in a vault. It generates no revenue, zero interest, zero cash flow. It's a completely inert asset. And in a world defined by perpetual inflation, an inert asset is perpetually losing relative purchasing power and carrying a massive opportunity cost.
And failure number two, poor liquidity and velocity. Selling billions of dollars of physical gold is a logistical nightmare. You have security, transport, assaying, clearing. It's a slow, cumbersome process.
Which means it has severely impaired velocity in a crisis.
So STRC's solution is structurally compelling because it provides the scarcity and hardness of digital gold, but it instantly solves both the liquidity and the yield problems. It provides the stability of a preferred security, which trades like a dollar-denominated bond, plus a substantial active cash yield.
And that substantial yield is the economic incentive that shifts the entire game. The annualized dividend rate on STRC was set high, reaching 10.5% as of late 2025, paid out monthly.
This transforms Bitcoin, which is an inert asset for a traditional treasury, into a high-yielding 10% cash flow machine, but one that's built with institutional-grade risk controls.
And this forces reserve managers, who are constantly seeking yield to offset inflation and maintain their reserve power, to reconsider the opportunity cost. If the choice is between inert gold that yields zero and is logistically a nightmare to move,
or a digital instrument backed by digital gold that yields over 10% and settles instantly,
the marginal allocation decision becomes very clear.
The brilliance here is the established mirror image to the T-bill. This is what's essential for institutional assimilation.
To gain broad acceptance, the instrument has to fit seamlessly into the existing traditional banking framework. When you present this to a traditional institution, they immediately recognize and accept the key features. A fixed par value STRC trades near par at $100 guaranteed stability, and regular monthly yield payments denominated in U.S. dollars.
They don't need to rewrite their accounting standards or fundamentally alter their risk models. This allows a bank or a sovereign treasury to hold an asset that is ultimately backed by the scarcity and energy of Bitcoin, but acts exactly like a dollar-denominated stability and yield instrument.
The corporate issuer manages the volatility risk internally, and it radiates stability outward to the institutional holder.
It's the highest expression of financial engineering, synthesizing a high-risk commodity into a low-risk, high-yield credit package that traditional compliance mandates are literally designed to accept.
Which brings us to the big question.
We cannot move on without confronting the biggest obstacle.
Yeah.
Volatility. I mean, central bankers are famously risk-averse by mandate. The typical 70% drawdowns of raw Bitcoin were always the insurmountably high barrier to adoption. The engineering had to solve the specific fundamental objection.
And the solution is twofold, starting with structural subordination, which provides the quantitative 80% downside protection. This is the linchpin of the entire architecture.
We have to visualize the capital structure of the issuing corporation, Strategy Inc. When the price of Bitcoin declines, the loss has to be absorbed somewhere. So it's absorbed at the bottom layer by the common equity, the MSTR common stock.
Right. Those common shareholders are taking the vast majority of the risk.
The preferred stock, STRC, is structurally subordinated above that common equity layer. And because of the massive size of the Bitcoin treasury relative to the amount of preferred stock they've issued, the preferred stock is engineered to remain unimpaired.
I mean, its $100 par value is intact.
Unless the price of the underlying Bitcoin collateral drops by approximately 80%.
80%. That is a massive buffer.
A huge buffer. To put that in perspective, while Bitcoin has seen severe declines in past cycles, an 80% sustained drop that breaches the entire equity stack is a rare tail risk event.
So the institutional holder of STRC doesn't need to worry about the daily 10% swings or even the severe 30% corrections that characterize a crypto market cycle. That volatility is contained and absorbed by the common equity layer below them.
This is how Strategy Inc. converts market risk into tail risk. For a central bank, holding a traditional T-bill means you're accepting political risk, the risk of a sovereign default. Holding STRC means you're accepting market risk, but only after an 80% capital destruction event.
Which is engineered to be a significantly lower probability than typical market movements. The volatility objection, that initial insurmountable barrier, is structurally neutralized.
But institutions, especially sovereigns, also worry acutely about liquidity and cash flow during a prolonged downturn. You know, what we call a crypto winter. If the Bitcoin price is crashing by 50%, how do they ensure those guaranteed 10.5% yield payments keep arriving reliably?
That's the second layer of protection, the dividend cover. And it's provided by a massive, dedicated liquidity reserve. Strategy Inc. understands that the stability of the yield is just as important as the stability of the principal.
We are referring to the establishment of that massive $1.4 billion reserve that was formally announced in late 2025. I mean, that scale is unprecedented for a corporate treasury structure backing a digital asset.
And its function is non-negotiable.
Yeah.
This cash reserve is strictly segregated and dedicated only to covering dividend and interest payments on STRC and other preferred instruments. It cannot be used for operational expenses, nor can it be used to buy more Bitcoin.
And the coverage analysis is just striking. This amount covers a full 21 months, nearly 2 full years of dividend obligations.
Even if the company earns zero revenue and the underlying Bitcoin asset is stagnant or dropping dramatically.
So this ensures yield stability and reliability, regardless of market conditions. When a sovereign wealth fund examines this package, a stable $100 par value, 80% downside protection against volatility, and a 2-year cash reserve covering a 10.5% yield, they are looking at a financially engineered fortress.
Right. But in the spirit of objective analysis, we have to address the two risks that are not eliminated by this structure.
Of course, the first one being counterparty risk.
Absolutely. The engineering mitigates Bitcoin price volatility, but cannot fully eliminate the risk associated with the issuing entity itself. What if Strategy Inc. suffers an operational failure or regulatory fines, or simply mismanages its non-Bitcoin business?
The existence of that $1.44 billion segregated reserve mitigates this by guaranteeing cash flow for 2 years.
It does, but ultimately the instrument remains a preferred equity obligation of the corporation, not a sovereign guarantee.
So this means that our risk manager has to assess the institutional durability and the governance of Strategy Inc., independent of the price of Bitcoin. That assessment is critical and requires traditional due diligence.
The second risk is equally important for a sovereign: regulatory risk.
This is an external risk. What if a major sovereign body, say the United States or the European Union, decides to ban chartered banks or institutional treasuries from holding instruments like STRC?
While the underlying asset Bitcoin is decentralized, the instrument, STRC, is issued under specific corporate and securities laws. A hostile regulatory environment could force institutional divestment, regardless of the instrument's structural integrity.
So while the financial fortress neutralizes the volatility fear, it transfers the risk burden to more traditional assessment factors, corporate solvency and geopolitical regulatory hostility. And this balanced view is essential for understanding the true utility of STRC.
Now, if we zoom out, we can see the profound ideological inversion that's inherent in the STRC strategy, assimilation over resistance.
For the first decade of its existence, Bitcoin was often framed as this existential threat, right? An anarchist tool destined to destroy central banks.
But STRC completely repositions Bitcoin. It is not a weapon of destruction. It is a path of assimilation, an elegantly engineered upgrade path for the asset base of the traditional financial system.
The narrative shifts entirely. It goes from the confrontational and the Fed to the pragmatic, almost irresistible pull of upgrade the asset base.
And this aligns perfectly with the conservative, slow-moving nature of central banking. Sovereigns don't need to adopt some radical new ideology. They simply need to adopt a structurally superior, high-yielding T-bill replacement.
The integration is marginal, just a single instrument, but the potential yield generation on state reserves is enormous.
It allows the traditional financial world to gradually migrate its collateral base from physical gold, which is inert, heavy, and centralized, to digital gold, which is active, liquid, and globally decentralized.
Okay, so let's discuss the complete architecture of digital money issuance that this structure enables. It really requires a symbiotic partnership between the corporate issuer and the sovereign regulator.
Right. The corporate issuer, so Strategy Inc. or similar specialized Bitcoin treasury companies, they act as the core fuel provider. They assume the high-energy risk of holding the raw Bitcoin mass.
And they use their engineering expertise to issue STRC, the refined, stable, yield-bearing fuel rods. They handle all the volatility engineering and the risk absorption.
Then the sovereign regulator provides the essential legitimacy. The nation itself doesn't have to buy Bitcoin directly or take on that price risk. Instead, they provide sovereign backing via regulatory charters. They could, for instance, create a digital banking zone or amend their reserve requirements.
And that new regulatory zone would charter local banks and grant them the legal authority to hold STRC as a primary reserve asset, exactly as they would hold a short-term sovereign bond.
And that sovereign blessing gives the entire system the legal certainty and legitimacy required for it to interact with the broader national economy.
So once the local chartered bank has this stable, yield-bearing STRC as collateral, it gains this powerful, profitable tool to issue digital money denominated in the local unit of account.
And this is where the concept of multi-denomination issuance, or tuning the frequency, becomes truly revolutionary.
The power of STRC stems from the fact that the underlying collateral, Bitcoin, is universal mass. It's denomination agnostic. So the stable radiation that's emitted from the STRC bridge can be tuned to any local currency frequency required by the population.
Whether that's the dollar, the rupee, or the dinar.
Let's analyze the two primary models this enables, starting with the digital dollar model, which focuses on enhancing stability.
Okay, so imagine a U.S. chartered bank operating under this structure. It holds a reserve base, maybe 80% STRC and 20% USDC, for immediate liquidity. It then issues a token that's pegged to $1.
The key detail here is the yield.
The key detail is that the yield from the STRC, the guaranteed 10.5% annual dividend, allows the bank to pay the depositor a massive interest rate, maybe 8% interest, while it retains a 2.5% spread for operations and profit.
That immediately makes this new digital dollar token vastly superior to traditional dollar savings accounts, which currently yield, fractions of a percent.
It injects active high yield into the world's most stable reserve currency, benefiting the consumer directly.
Now consider the second, and arguably more transformative example. The digital rupee or digital dinar model. This is critical for emerging markets.
It is. These nations often suffer from higher local inflation and have lower yielding, often volatile, local government debt.
So if a sovereign-backed bank in, say, an emerging economy issues a digital rupee using the system, the backing is radically superior. It's not reliant on low-yield, inflation-prone local government debt.
The backing is global digital capital Bitcoin, and it's accessed via the high-yield STRC bridge.
And the STRC yield, at over 10%, is powerful enough to absorb the local inflation rate,
which allows the bank to offer a hard rupee, a digital currency that structurally preserves purchasing power better than the state's own pure fiat currency. It immediately upgrades the quality of money available to that nation's citizens.
And it's all done simply by shifting their reserve collateral base from volatile political debt to stable, yield-bearing digital mass.
This changes the fundamental game theory for nation-states. If a sovereign can allocate even a marginal fraction of its non-yielding reserves, whether they are physical gold or low-yield foreign exchange to STRC.
They secure a stable 10% yield and indirectly anchor their own fiat currency to the heaviest mass in the digital universe.
This creates a critical first-mover advantage. The first nation to adopt this integration wins the race to offer the most stable, highest-yielding local currency. They stabilize their national fiat currency not just with their local tax authority.
But with the accretive, yield-generating power of globally recognized digital assets, the STRC bridge provides the blueprint for universal currency stability, independent of local political volatility.
That is the power of engineered finance meeting digital scarcity and velocity.
This has been a monumental deep dive into the engineering of value, really dissecting how an instrument can turn chaotic volatility into predictable yield. Let's briefly summarize the complete system we've described. I think understanding the three components is key to understanding the future of global money.
Okay. We have defined a complete self-sustaining architecture for value creation and transmission.
Component 1, Bitcoin. This provides the raw, concentrated mass, the pure, immutable digital energy, the ultimate store of value. It's the heavy, unmoving anchor.
Component 2, STRC. This is the bridge, the engineered financial transformer. Its function is pure conversion, absorbing chaotic mass volatility and outputting stable, high-yield credit, backed by substantial cash reserves and structural subordination.
And component 3, sovereign-backed corporations. These entities, operating under a national charter, provide the crucial distribution, the stable, high-velocity radiation denominated in local currency and made instantly usable for daily commerce.
And the system is designed not for confrontation, but for stability and global velocity. It achieves a profound marginal improvement by integrating the universal decentralized integrity of Bitcoin with the necessary localization and utility of national fiat.
The final synthesis is clear. Any nation, regardless of its current geopolitical size or economic strengths, can upgrade its currency and financial infrastructure. The resulting digital dinar, or digital euro, issued on this standard is a high-frequency transmission of pure Bitcoin energy, perfectly stabilized for daily use.
It offers the universal integrity of digital scarcity with the localized familiarity and utility of national currency.
So here's a final thought for you to chew on. If we zoom out one last time, let's just consider the nature of money itself. For the entire 20th century, military strength and geopolitical dominance were the necessary coupling constants for a fiat currency, like the US dollar, to function globally.
The system worked because the value was enforceable by force and political decree.
So what does it mean for geopolitics? For global power dynamics? What happens when the new coupling constant required for currency stability is no longer military might, but a yield-bearing financial instrument, STRC, backed by immutable digital energy?
If money evolves from being a fundamentally political construct to one based on structural, physical mathematics,
Right.
does it de-risk the global economy from political instability?
We encourage you to explore the implications of a physical versus political definition of money in the 21st century. What stands out to you?
We'll see you next time on The Deep Dive.